What's up, team, and good afternoon. It is a hot day in San Diego today, and it is a hot time in the San Diego real estate market. Today, I'll talk to you about interest rates, what's happening there, potentially really bullish news for mortgage bonds. We'll take a look at the chart. Also, going to look at some stats here for San Diego real estate, get the reality behind it. We know what the frenzy is about. We know there's an inventory shortage. What do the numbers say? We're going to take a look at that as well. I'm going to look at a couple of things regarding the Fed, inflation. We'll get to all that too. And then just my experience about what's going on the ground level here as we have, a tremendous amount of activity taking place. We have a lot of things happening. If you or someone knows a veteran who wants to buy or refi, have them give me a call, shoot me an email, send me a text right here. I'm dedicated to helping veterans utilize the VA home loan benefit without paying exorbitant fees and getting great interest rates. That's what we do. So let's take a look here. We'll go ahead and dive in on this beautiful Thursday. So we're looking at mortgage rates here. Quick recap. If we go back here, clearly the trend has been lower mortgage bonds, which means higher interest rates. That's been going on since January. The very beginning of the year is when we topped out. And we've had a little recovery since then, which is still running. This is going higher. Remember, we want bonds to go higher so rates can go lower. Couple things. So we're sort of in a pinch here at the moment. So we've touched this resistance level twice and bounced off of it. Now we've come down here and we've touched this support level twice and both time bounced off of it. I will tell you, this candle right here is a very bullish looking candle. Okay. So it is entirely possible, even though this drawing tool isn't perfect, it is entirely possible that we could continue to go higher. However, this is still a locking situation. You still have to lock. You have to lock here because you have a very short distance to resistance, which has, we've failed to get through there twice. And you also have, what's the risk reward? I mean, even if you make it through that, you've got another layer not too far away and then another layer not too far away from there. And those are actually big moving averages. That's the 100 and the 200-day moving average. Those are going to be very, very difficult to get through. So because of the suppression here of bond prices for so long, this really feels like a dead cat bounce. I do think rates are going to go higher long term. Maybe we can get a pop or something here if the stock market could continue to take a breather here and there. That's very, very helpful. But you'll see here, since this rebound, a lot of green candles. The green candles don't always mean a win, like from here to here. That's a day where we're down. Today we're up 8 basis points with a very good looking candle. So you would typically say, let's float. We got a great looking candle. We're up today. This isn't priced into the market tomorrow. We can probably open up better. That's kind of how it feels. But unfortunately, just given the risk reward of the situation, I would say lock here. And if things get better, tomorrow, then, and you get a new one tomorrow, then lock again. So we should have a locking bias here. I know Barry's doesn't have a lock bias. He hasn't told us to lock since back here. I locked here, and I've locked really all along this path. For a lot of people, these are daily candles. So if you go back 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, that's 2 weeks. So this is 2 weeks ago right here. And I've locked a lot of people in this range that we're in right now because, the risk reward is just there to lock. So encourage people who are getting into escrow to really take a look at locking. Some loan officers are a little bit lazy with this. And, they'll take a few days to get around to it. They'll let it get into processing and, all these different things happen before they actually take a look at locking it. They really should take a look at locking as soon as the contract gets in. You get the appraisal ordered, should be taking a look to lock. I would probably pull the trigger here. Now, we're seeing a lot of rates in the 2s again, even though bond prices haven't got back up to where they were. This number up here, this resistance line that's marked in purple, that is the all-time high at 105.63. Currently, we're at 103.56. Oh, wow, how about that? So 105.56, 103.56, we're exactly 200 basis points away from the all-time lows in mortgage rates. And if we got 200 basis points on where we're at today, we would definitely be, back at that 2.25, VA FHA rate with lender credits. I mean, it's just crazy times, right? I don't know if we have 200 basis points in us here or not. And part of the reason is because of the inflation situation. And so I'm just going to briefly talk about that because inflation is the enemy of bonds. I mean, if you think about it, this is a 2.5% coupon here that we're talking about. That means that if you buy this at 100, okay, which we're not at 100, we're at 103.56. If you bought this at 100, you're going to make 2.5% a year. Now, if we're seeing runaway inflation, 2.5% a year isn't enough. You're losing money at 2.5%. So it's a wonder that anyone purchases these, to be honest with you. But the government obviously has a big stake in that, which is why it's interesting. I don't know if you guys saw this or not. Jerome Powell, heavy favorite on Wall Street to be renominated as Fed chair. Does Wall Street choose the Fed chair? Is that how it works? Somebody tell me how this works. Because Wall Street, of course, they would like the guy who has, as far as they're concerned, he's got the diamond hands. Hey, let's not worry about inflation. What did he say this week? He said, hey, inflation is here. It's going to get worse, but it's temporary, so don't worry about it. It's temporary? What are you talking about? It's temporary. I've actually got, I'll just pull this up on Twitter. Let's see. I may need to move myself out of the picture a little bit. Can I do that? Get myself out of the way here for a second. Okay, so let's take a look at this. And this is really, really, really good stuff. Okay, this is actually from the St. Louis Fed. You want to know, does CPI really measure inflation or not? This is what the Fed's looking at. And you can look here, and we're going back to 1990, and we're assuming 100 as the basis here, which I love that, so it's easy to factor in. And you can look at everything. Consumer Price Index, that's this one. CPI is actually the lowest. So if this is supposed to be a measure of the average, it should be somewhere in the middle here. I mean, we're talking about Big Mac price, median house price, oil, tuition, child care, health care, copper, gold. And then they put in a couple fun ones, the New Yorker cover price. Those things are kind of fun just to kind of see. But, you can see the CPI is telling us that since 1990, it's 31 years, that we've just basically seen a double in inflation. A double, which should also be concerning, but that's it. That's all, just a double. We went from 100 to 200, 200%. 100% gain, 200% of the basis. But if you look at some of the other things like, the Big Mac price, that's been a really, really solid indicator. That's more like 350, not 200. Big difference, right? And there's other things that show, a higher number as well, including gold and a couple other things in oil. But either way, what this graph shows us is that the inflation data that we're getting is not really reflective of everything that's going on. I mean, tell me something that's gotten cheaper in the last decade, much less the last 30 years. These numbers should be higher. But the CPI, we're counting on that to really give us, a true median of what's going on, and it just simply isn't doing that. So, while Jerome Powell may be the heavy favorite on Wall Street to be renominated, and not saying that he's doing a bad job, but I don't think we're getting the full truth, team. I do think there's more inflation here than it looks like. And that's part of the reason why I'm not super bullish on rates going lower over the long haul. I think we can see some more upside maybe, but right now what's kind of forming is almost like the perfect bullish trap. Or it would really be, it's a bull trap. So it's a bearish setup, meaning that, if this goes higher up into here, I mean, it could get, it could come off of these moving averages really hard. Like you could come off the 100 or the 200 really, really heavy and hard and relentlessly. That could be what the sellers are waiting for. Sellers sold this thing all the way down here. So now we're much higher than that. They could just be waiting for it to get to one of these major moving averages to hit the sell button again. I'm not sure. But, if you bought this at 100, you're still selling it for 103.56. You're doing pretty good, right? Not assuming you picked it up at 100, but so there's profit in these bonds still that can be let out, and I think we are probably going to see some of that. So let's take a look at real estate here. And by the way, if you're getting this video, you're pre-approved with me. I'm sending this video to you because I want you to know what's going on. Just all overall, rates look good. Don't know how long it can last. Possibly a little bit of upside, maybe not. This is an interesting one. I'm just going to go ahead and leave my thing right there. So I like Altos Research. This is the city of San Diego. So if you're looking in like Oceanside or, Riverside County, this isn't exactly, accurate information for you, but it gives you an idea of the market. And the thing that I like to look at the most is price per square foot. And the reason for that is because price per square foot doesn't have any other factors into it. And what it does is it tells you how much people are willing to pay for the same house. So if I have a 1,000 square foot house and we're paying $500 per square foot and it goes up to $550, I'm going to see a 10% increase in the value of my home, right? And it's not exact, of course. But this Altos Research shows us that, and this is just, we're going back to May of 2018, where we were looking at the average around 450, and then we go here to May of 21, or almost May of 21, basically a 3-year move. And we're at, let's call it 580. Okay, the split between the 7 and 90. Let's call it 580. So we went from, let's call it 450, 455, let's say, 455 to 580. So 455 to 580. So what's 580 divided by 455? So 27.4% increase. That makes sense. It's 3 years, 9% a year, approximately. That's about what we're looking at. Look at how steady and how just sort of relentless and steady this has been. I mean, that is truly a really good looking chart. That doesn't look like any kind of bubbleiciousness. Everyone keeps asking me, when's it going to crash? When can I get a deal on real estate? The best time to buy real estate was 20 years ago, my friends. And hopefully 20 years from now will come for all of us. Median list price is another one. This one can be deceiving because list price doesn't imply something actually sold, and there's, if you look at, let's see, average days on market, real estate market action, okay. So median list price, this is about as good as you're going to get from Altos anyway. And you can see this one has some more fluctuations to it. But, the list price, like I said, those homes don't always sell. So you're going to see a little bit more fluctuations with that one. And if you look at that one, you can see that we've actually seen a decline since September in the median list price. No one's talking about that. Pretty interesting though, yeah? Decline the median list price. That doesn't mean a whole lot, but it is interesting to note. Now, let's go up here and look at some of the key stats. And I'm going to get myself out of the way and reposition. Okay. One of the things that's really valuable here at Altos is the market action index. And this is showing a 94. I've never seen it that high. 100 is the highest number you can get, meaning it's a complete and total 100% seller's market. I don't know how it's not at 100 right now, but right now we're at a 94. Highest I've ever seen it. This shows you for the area. And by the way, you can go to altosresearch.com and you can pull up your specific area you're looking in if you want to get more detailed information. But median list price, you can see here, and it takes you back to the beginning of the year and shows you, okay, we were at 995. Now we're at 1,049 or 1,049. Median price of new listings, price per, so there's ones that aren't coming back on the market. That's interesting to note. Price per square foot gives you a little graph on that. You can see, we were at 566. Now we're at 582. We peaked at 596. You can kind of see those things. Average days on market definitely declining. Look at where it was just on January 8th. On January 8th, we had 69 days average days on market. Now we're at 38. That's pretty wild, isn't it? Those things are really interesting. Median days on market. Median days, 7, team. So when I'm telling you, like, okay, hey, in order to get our offer accepted in this market, we've got to do some things. And we're starting to do a few new things that we think will be really helpful as far as just going and getting underwriting approval, TBD, before we have an address. So we can write those offers basically with an underwriting approval attached to them. Doing appraisal bridge, offering whatever you're comfortable with, if you can, above what the home might appraise for. Appraisal bridge has been huge. That's a great way to help strengthen your offer. Obviously, money down and credit scores and all that stuff is good too. But it's time that we have to kind of go above if you want to win in this market. And we've had great success doing it. So I would definitely follow our lead on that. And if you look at this, median days on market was 42 January 8th, and it's 7 now. So that shows you that, things are happening very, very quickly. There's no doubt about it. Price decrease. So the number of listings that have a price decrease or a price improvement, as we like to say, this has always been around 25%. I mean, for as long as I can remember, you could always check this, and it's somewhere around 20 to 30. You're right around 25%. Started the year off 26. Now we're at 16. Almost, so very few homes are having a price decrease. That's about 1 in 7. Price increase, very small amount. That really should never happen. Relisted is at 14%. And you see the inventory here, only 375 total, which is nuts. The median rent, I also wanted to show you this. Median rent is pretty flat, increasing though, up $100 since January. But look at that, the graph is kind of up and down, up and down, up and down. So you're seeing a choppy but still increasing rental market, which is great. And it's great for homeowners, for real estate owners. It's not great for renters. We started this year at a market action index of 75, and we're now at 96. So that just shows you things have really heated up since the beginning of the year. Everyone expected the opposite. And obviously we're seeing something different now. We're seeing, this inflation that we're talking about really, really coming to fruition in real estate. Real estate is a great place to be during inflationary cycles. And we're in the midst of really the beginning of a gigantic inflationary cycle right now. And sometimes I don't want to say these numbers because they're scary, but the amount of money the government is spending is so much more than the money that all of the businesses in the entire country make, that it would be like if you made $100,000 a year, you had to pay taxes on it, but you spent $200,000. It doesn't take very long for you to be in a lot of trouble doing that. So just wanted to, make sure that we know what's going on, what some of the numbers are, where to research some of this data, where to get some of this information. Of course, you can subscribe, mbshighway.com. Barry B puts together these mortgage bond charts for us so that we know what's going on. Keep an eye out on things, we're seeing, the long-term capital gains tax has been, it's floating out there that's going to be increased significantly. And if that happens, it feels like kind of a scam, doesn't it? I mean, it's like, hey, the government artificially lowers interest rates, so making stocks pretty much where you have to go to get a return on your investment, unless you want to go into crypto or real estate. Really, stocks is where you go for your retirement account. And so then you have huge gains in stocks, and then they want to come in and take half of those gains away. And that's not for everybody. It's just for people who make certain incomes. But you always wonder, it's a slippery slope. When does that stop? If the government is this far in debt and this far upside down on their balance sheet, what kind of lengths are they willing to go to? I think real estate is still number one. It still makes the most sense of all investments, especially in an inflationary cycle like the one that we're in. And the question is just, how do you win? How do you win? So we're talking appraisal bridge. We're talking about getting pre-underwritten. We're talking about, being out and open in the market and looking for different ways to communicate with the seller to let them know that you've got a really, really solid offer in hand. So that's what we're working on right now. If you have questions about any of this stuff, give me a call. If you know a veteran who wants to buy a refi, have them shoot me a text, send me an email. We will take care of them. We will not charge them any BS fees. They will get a great rate, and they will get a full education. Lots of videos like this one, letting them know, hey, this is what's going on. This is what's happening in the market. Let's see how we can win together. We're using relationships. We're using strategy. We're using everything that we can to help our clients win in this market, because we know one thing for sure. The amount of San Diego real estate that is being built does not even come close to satisfying the demand. So what do you do when you know something is in demand? There's not enough supply. What do? You pull the trigger. You buy that thing. Doesn't matter what it is. Doesn't matter if it's Bitcoin. Doesn't matter if it's oil. But particularly real estate in an inflationary cycle, because it's the one thing you can count on to always be there. It's always going to be real estate. There's only so much of it, particularly in San Diego, or even Southern California for that matter, but particularly in San Diego, there's only so much of it. All right, we've got the ocean one direction. We've got military base to the north. We've got desert to the east. There's only so much sweet spot there. And builders are having a hard time generating units here, and that trouble is only going to get worse over time. The difficulty they're having with constructing new single-family detached homes is only going to get more difficult over time. And if you can purchase one of those, you absolutely should do it, because you will be very happy that you did in the long run. All right, hopefully that's helpful for you today. Appreciate your time, team. Have an amazing day, and I'll be here if you need me. Take care.